Hey, Equity Mates. Really appreciate the support and love that we get from all of you guys. Obviously, we are doing this for free. We don't expect any money from anyone, and we do it for the love of investing and equities. But there is one thing that we could really appreciate your support from. Ren?
Oh, great. Yeah, look, we don't ask for money, although if you want to send it our way, we wouldn't say no. But the biggest thing you can do to help us grow the podcast, to get more people listening, is to just jump on iTunes or whatever podcast platform you use and give us a rating. Ideally 5 stars. If not, if you think we're only worth 3, then that's your decision. But yeah, it helps us massively in the ratings and to get more listeners and to grow the brand.
Nice. Leave a review and also tell your mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we will help you learn to invest in 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. Well, I always say I'm very good, but we're both probably going to be a little bit slow for this episode.
Why is that?
Well, you had your Christmas party last night, and I'm actually bookended between my team's Christmas party last night and my whole company's Christmas party tomorrow. So,
well, I've also got we've got our sort of grad group Christmas party tomorrow night as well. So Christmas parties all around for us.
Yeah, this is the danger of recording these episodes in the few weeks before Christmas.
True.
Yeah, well, we just have other things on. But, you know, we persevere.
We will. We do. We will have to update on how the Christmas parties went on our episodes in January, because we'll be recording the rest of the episodes for our summer series before we hit up our Christmas party tomorrow.
True. I think knowing your form, mate, probably good that we're not updating the listeners.
I was going to say, you need to watch yours.
Yeah, but I got in there first. No, look, Bryce, we all know that you love a good Christmas party. You know, so you were telling me that the Woolies Christmas party is 2 hours in the car park. Word on the street is that's because of your performance there a couple of years ago.
I had such an effect that 5,500 people have had to have a Christmas party in the car park instead of, well, where else could you fit 5,500 people, really?
Hyde
Park, I guess.
The convention centre?
Yes. On a boat.
Yeah. So is that why they call you the Grinch around the office? Because you ruin Christmas?
Anyway, let's move on, Ren. We're here, Ren, to talk about a company, our 4th company on the list, I think, for our summer series. And for those of you who have just joined the show, welcome. Ren and I, by this point, will most certainly be on holidays by the time you're listening to this. And we have decided to deep dive into 5 companies from the Australian Stock Exchange over the summer, and give you guys a bit of an insight into A, the company that you may never have heard of before, and B, just introduce you to some of the ways that we look at information to do with companies, and some of the different ways that you can value companies and start to make a bit of a thesis about companies to help with your investing decisions. So, Ren, today we have Doriemus PLC. Do you think I pronounced that correctly?
Yeah, probably. Doriemus? Yeah, let's go with it.
Yeah, Doriemus PLC. Its ASX ticker is DOR. So if you want to follow along as we do this, jump onto the ASX and type in DOR or Yahoo Finance or wherever you may be looking for information. Ren and I usually start with a Google search. Would you agree, Ren?
Yeah, generally... Yeah, or actually always a Google search.
Always. So how did you want to structure this one, Ren? Obviously, we'll start a bit about what Doriemus does. Is anything in particular that you want to call out with this company as we go through?
Honestly, this is probably the one I have the least on. So I didn't do a lot around its industry and competition just because, well, we'll get into what the company is. But yeah, let's just do the company, have a look at its financials, a little bit on valuation.
Call it a day.
Call it a day.
Nice. All right. So what is Doriemus PLC, DOR? What I've come across, Ren, it's a UK-based oil and gas exploration and production company with its strategy to be either acquiring interests in oil and gas assets, either by directly or through licensing or buying into companies that themselves own oil and gas assets. And their current base of assets is primarily in UK oil and gas sector. And from what I understand, they're trying to broaden their base into the Asia Pacific region, which is why I would imagine they are listed on the ASX. Anything to add to that, Ren?
No, look, I think that sums it up quite nicely. They were actually listed in London on the NEX, which is another exchange, and then they moved to the ASX. I think they were dual listed for a little while, but then they were removed from the NEX, the London exchange, one of the London exchanges, in March 2018. So pretty recent. But yeah, like as you said, all of their interests, all of their oil and gas interests at the moment are in the south of the UK.
Yeah.
When they listed in Australia, they listed to raise $3.5 million, and the issue price that the shares were issued at was 26 cents.
Oh, wow.
So if you're an investor, you might be a little bit disappointed because as of the 13th of December when we're recording this, they're trading at 8 cents. So
they've lost 60% thereabouts.
Yeah.
Wow.
So not ideal, but
no.
There you go. One thing that I found quite interesting, and how I found this information was just reading through their last annual report, which I'm pretty sure was financial year. It was calendar year 2017, I think. So as you said, they are an oil and gas company.
Yeah.
But interestingly enough, they're not really operators in any sense of the word. Like they're not operating any oil and gas fields and extracting these resources. And similarly, they're not an explorer looking for drilling and looking for oil and gas deposits. Instead, all of their interests are minority interests. Yeah. So there are 3 oil and gas fields, major ones, and then there's a couple of minor ones. Brockham oil field, they own 10% of. Lindsay oil field, they own 20% of. And Horse Hill, which I think is their biggest one, they own 10% interest in an investment vehicle that owns 65% of the oil and gas field. So effectively, they own 6.5%. So really, to my mind, they're an investment company.
I completely agree. Yeah.
Yeah. And what they do is they invest in oil and gas projects that they think will do well, but they're not actually operating anything. So they don't take any of that operational risk. Yes. They just own minority stakes, and the reason you would invest in this company is if you were confident that their management
exactly.
could make correct investments.
I was just about to say that that is exactly what you're doing. You're not really investing in their ability to go out and find oil and do it at a cheaper cost than their competitors or anything like that. Yeah, you're just investing in the management of the company and their ability to choose the right, I guess, assets to invest in.
Yeah, 100%.
So, yeah, it's an interesting one. So, market cap of $4.03 million, Ren.
Yeah, so pretty cheap.
Cheap? Whoa, you and I could buy that.
Well, maybe. Maybe once we get some ads on this podcast.
Absolutely cannot buy that for anyone listening. So why is it so small?
Well, because it doesn't have any revenue.
Yeah.
And it lost
nothing.
It lost £2.76 million in its last annual report.
Yeah, interesting. Because it listed on the ASX in September 2017. Yeah. So in terms of data for ASX, it's only got 1 year. Last year. And so this is a good lesson, I guess, is if you wanted to go back, you've managed to find data previous to its listing in Australia by going onto their website, right?
Yeah, into that annual report.
Mm. And could you have gone back further than 2017?
Oh, I'm pretty sure you could. I can't remember from memory, but yeah, I'm pretty sure you could.
Yeah, okay, cool. So they made a loss then.
They did. So calendar year 2017, they had no revenue.
No.
And they made a loss of $2.7 million. that was primarily driven by 1.6 million in a share-based payment charge, 500,000 in ASX listings costs, and then $500,000 in administrative expenses. So over 2 million of that was from listing and, by the looks of it, share-based payment charge. I'm not 100% sure what that means. But yeah, so you would expect that that's likely going to be a one-off. The year before they lost $700,000. So still a loss, still not great, but I think the 2.7 is probably an outlier given the listing in Australia.
And did they have a revenue in 2016?
Yeah, they made a whole $1,000.
Interesting. So it's an established company. It's not a new company. I don't know how long they have held the interests in these oil fields, but you would assume that within the last 2 years, they would be making some sort of revenue from those oil fields. Like, I'm interested, and I haven't been able to really find, is how they're invested in, they've got 10%. What's the revenue stream from these oil fields, I wonder? Is it just based on, 10% of 30,000 barrels produced a day, or...
Yeah, look, it would be, but I'm pretty sure most of the oil fields they own, they're still testing in. They're still doing like extended well testing, or they're making sure that they can actually mine some of these places. So I think your logic is right, but it might just be too early.
Well, Lindsay's been in production since 2008. I know that. I don't know when they got their 20% stake in it though, so maybe it kicked in or not. But yeah, Brockham and Horse Hill, I'm not sure if they're up and running yet. But yeah, I'm interested to know when they're going to start making some revenue, because they've made $2.7 million loss.
Yeah, interesting. So looking at their half-yearly update this year, so yeah, it looks like they are pumping oil. So Lindsay announced, in March they announced that 2 of the wells at Lindsay had been placed back on production. So yeah, you're right. Look, they are pumping oil. Well, the things they've invested in is pumping oil. So it's a good question why there's no income coming from it. Looking at... Oh, no, here you go. So looking at their revenue for the 6 months ending the 30th of June 2018, they had $13,000 in revenue. So...
Still, not what you'd expect for a 20% stake in an oil field, that's for sure. Unless this oil field's literally the size of the olive oil container I've got in my kitchen right now, but...
Maybe. Yeah, it is strange. So it's an interesting one. If you look at the value of their assets, so if the investment isn't producing income, maybe it's increasing in value, and that's where the value is coming from. But
the value of their asset is primarily driven by the price of oil, though, and we know what's been happening to the price of oil over the last 6 months or so. Yeah,
but also as you get closer to production, you would expect the price to improve. But I've actually got it here. So at the 30th of June 2017, it was worth 1.1 million. By the end of 2017, it was worth 2.2 million. And then by halfway through 2018, it was 2.3 million. So it hasn't really appreciated that much. So yeah, it is interesting. And I guess we haven't done the full research to understand exactly what's going on at all these oil and gas fields, but just looking at what they're updating the market, you'd be a little bit concerned about putting your money there.
Yeah, absolutely. I'd want to know a lot more before I start going down this track. I'm not really a fan of commodity-based investing like this anyway, but I'd like to see some more numbers on the page for sure.
Yeah. So in the half year to the 30th of June, it lost £396,000 on £13,000 of revenue. So, yeah,
burning cash.
Yeah. Anyway, that's the company. That's its financials. I did want to finish a little bit with some valuation. So unless you have anything else about the company itself.
No, nothing to cover from my side. We've discussed the 3 oil fields, which was primarily what I wanted to talk about. So hit us up with your valuation. Ren, what do you got?
So similar to what we were saying earlier, because they just hold minority interests in these oil and gas fields, they're basically just investors. So when you think about valuing them like a listed investment company, that's based on the value of the assets. So if you look at their balance sheet, this is based on the 2017 end of year report. They had oil and gas properties worth $2.2 million. They had $1 million in... Oh, sorry, this might all be in pounds. $1 million in investments available for sale. Receivables in $700 million, most of which was a loan to a joint venture partner.
Mm-hmm.
And then they had $1.1 million in cash, which brings you to a total of $5 million. So they had $5 million worth of assets that, if they needed to, they could sell for cash, and you as a business owner or part business owner would be entitled to your share of that $5 million. However, they had liabilities, so debt of $437 million, which brings their net... Oh, sorry, $437,000, I'm pretty sure.
Okay, yeah, that makes sense. They were surely not $500 million in debt.
No, surely not. So
No,
on 13,000 revenue. 437,000, excuse my typo, which brought their net current assets to $4.56 million. So as an investor, you're saying if something went wrong with the company and they had to sell all of what they could, they would get about $5 million, and then they would have to pay off their debt with the 437,000, not million, which leaves you as a part business owner with 4.56 million. Now there are 50 odd million shares outstanding. So if you say that the share price is 8 cents as of today,
yes,
and there are 50.42 million shares,
yeah,
you get a market value, what we were talking about before, of 4.03 million. Yes. And so when you compare that to the net current assets, it's just a slight discount to the 4.56 million in net current assets. So essentially what the market is saying is that they want a margin of safety of, about a 10% margin of safety, a 12% margin of safety if the company had to sell everything, pay off its debt, and then return money to shareholders. You as an investor would get your money back, essentially based on the current share price. So, I mean, it's probably not a company that I would look to invest in because you don't really see a path for it to make a lot more money. Maybe if the oil and gas fields start doing well, but in terms of how the market's valued it, that's the sort of process that it's gone through. Looked at what the company could be sold for, and then has priced it a little bit below that.
Yeah, nice. It may sound complicated to someone who's just joined the show as an investor, a beginner investor for the very first time, but have no fear. What Ren is talking about is a relatively simple concept to work your way through. Ren, where did you find that information and that breakdown of assets and liabilities to work out its total net asset?
Yeah, it's a good question. And yeah, I probably could have explained it a bit more simply. There's a page in every company's annual report that companies have to produce every year that shows their balance sheet. And it has all those categories that I just explained listed on different lines. And then at the end, it will have net current assets, net tangible assets, something like that. And that was that number that I ended up at. So the company will spell it all out for you. So all there, they have to report it every year, or most companies report it every half year at least. So yeah, it's all available through the company's website.
And then total shares outstanding. Do you that is essentially all the shares that are available out there on the market. Where did you find that information?
That I found on, I'm pretty sure it was on Yahoo Finance.
Nice, Ren. So we found a cheap company, not all, 8 cents in its price, $4.03 million market cap, trading at a discount. Would you buy?
Look, maybe at a certain price. If we say, yeah, look, I don't know.
I'm not convinced.
I mean, if it was trading at like 5 cents, maybe, but probably not. Would you?
No.
Okay, there you go.
No.
Not even if it was trading at 1 cent.
Oh, I mean, no. No. So Ren, Doriemus PLC, it's essentially an investment company that looks at oil and gas assets in the UK, listed on the ASX stock exchange, and neither of us would like to invest in it.
No, well, yeah. I think,
so it's been good. A good way to work through it. I think we've come we've certainly raised some questions that we would like to know more about if we were to pursue this a lot further. And I think there's more questions than answers in my mind at the moment. And I guess we've highlighted, you've gone through a really simple way of coming to a valuation for the company that uses information that is readily available to everyone. And yeah, anything else to add?
No, that's about it.
Well, that's the second to last episode for our summer series. Next week, we will be doing our final one, which I'm a bit sad about, Ren. I've really enjoyed discussing this. I think we'll hopefully carry this into the new year in some new way, I guess, depending on how we react to it. Great exercise.
I definitely think so. I think if listeners have got value out of it, let us know, because I've definitely enjoyed doing it as well.
All right, Ren. Well, let's leave it there and we'll talk next week.
Yeah. See ya.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.